If you've ever lost money with options, then this video is for you. And I think I found the secret to not losing money. I know, that's what they all say. But stick with me because we will go through all of that step by step, and in this video, hopefully turn around not losing money into making money. Because making money is always the better option. Get it? Option? Because we're talking about options. All right, moving on. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and in today's video, we are talking options. More specifically, we are going to go through different option strategies and look at their max gains and their max losses. By putting into perspective how much money you can make on a trade, but also how much money you can lose on a trade, will give you a better overall understanding on how to avoid the losing side and ultimately make more money. It is something that has helped me a lot in my trading, and I hope that it will help you as well. Now, at the end of this video, I have a little bonus tip for everybody, so stay tuned until the end for that. Smash the like button if you are ready to begin, because if you're ready, then so am I. Let's go. Buying options is one of the most, if not the most popular option strategy that you would see nowadays online, especially with the popularity of Wall Street bets and the massive gains and losses associated with it. Now, the reason that buying options is probably the most enticing is because you can make crazy returns, but also lose all your money. Now, let's break this down. When you are buying an option, you are either buying a call or buying a put. If you buy a call option, you are hoping the stock goes up and reaches your strike price and hopefully goes above it. If the stock goes way beyond your strike price, then you will make a lot of money. You can double your money overnight, triple your money, or even sometimes 10x your money with the right options and a bit of luck. Now, on the flip side, how much money can you lose when buying options? Well, the answer is everything. 100% of what you put into the option to buy can be worth zero, and you could just lose everything. Now, this happens if the stock does not reach the strike price by the expiration date. Now, this is the same thing with puts. When you buy a put contract, you are hoping that the stock goes down below your strike price. If the stock doesn't get there by expiration, then all of the money that you put into buying the put is now worth $0. Congratulations. So Alex, is this like gambling? Yes, it is. Well, sort of. See, this all depends on the expiration date. You can buy options with an expiration date of as little as a few days away, which we would call weekly options, but you can also choose expiration dates with months away or maybe years until expiration. The more time you have on your contract, the less likely you are to lose everything because you will have time to see how the trade goes, and if it's going against you, then you can sell and only take a small loss rather than losing everything. Also, another thing to consider is buy in the money options rather than out of the money options, because in the money options will always have intrinsic value left, so you won't lose everything. Now, do yourselves a favor. If you are new to options, you want to click here to go through some of my other option videos where I will teach you about in the money, out of the money options, and how you can use options in a safe, professional manner rather than just gambling at the roulette table. Now, one thing that I want to say is that if you want to throw a small amount of money into buying shorter term options and essentially gamble for the experience at least, then do it and see for yourself how risky this can be. Just know that you will most likely lose all your money that you put into that trade. And even if you get lucky a few times, this sort of investing is not sustainable for the long term, right? Let's now move on to selling covered calls, because I get this question a lot. How much can we lose if we decide to start selling covered calls on our portfolio? So by selling calls, you are agreeing to sell shares of the company that you are trading at the strike price that is chosen if the strike price is reached. Now, selling covered calls consists of owning 100 shares of a company and selling call options against your position and collecting a premium. This is basically taking the other side of the trade of the person buying the options, right? So remember, in our first example, we were buying options. Well, who are we buying from? The answer is the person selling the options. And guess what? We can be that person. Now, they say that 90% of out-of-the-money options expire worthless, so statistically, you are way better off selling options rather than buying them. But I digress. When you sell a covered call, you are using that stock as collateral to cover your trade, hence the name covered call. So if you own 100 shares of Apple and Apple is trading at $100, let's say, I can sell a call with a strike price higher than what Apple is currently trading at, let's say $110. And I collect a premium from the person buying that option, the person paying that premium. I get paid cash right away into my account. Now I am hoping that Apple does not reach $110. The buyer of the option is hoping that Apple does reach $110. So now it's a battle between the buyer and the seller. Now if Apple does not hit $110, then you get to keep the entire premium that you collected. So the max profit on this trade is the credit received for this trade. You can't make any more than that when selling options. Now let's say Apple reaches $110 by the expiration date. Let's say it's at $115. Well, you lost the trade, so what happens now? Well, because you agreed to sell your shares at the strike price by entering into the options contract, then you have to sell your 100 shares at $110 per share. Now, your loss is just that, your shares. Oh no, my shares. The dollar amount of your loss will depend on how much you bought Apple for to begin with. If you bought Apple last year for, let's say, $70, then you are already in the profit. You bought it at $70 and we were forced to sell at $110. Well, this still made profit. Not only that, but you got paid a premium on top of that. Now, what else did we lose? Well, we lost the potential to make that extra $5 per share. Right? You sold Apple at $110, but it's now trading at $115. $5 per share times the 100 shares is a potential loss of $500, even though you haven't lost that actual money, you just haven't made that extra money. So the $500 is the potential profit that you could have made if we weren't forced to sell the shares. But that's not necessarily, again, money lost. So selling covered calls can be confusing because of our misguided assumption that we could lose money by selling at a lower price. But we can see the reality is just that you're just not making money, okay? So get that through your head for selling covered calls. Now, sure, if you would have bought Apple at $150 and then it's trading down at $100 and then you were forced to sell at $110, then yeah, you lost money, but this is why you should avoid ever selling covered calls if you are not in the profit already with your long stock position. So one tip is always have your strike price when selling calls higher than the price you bought the stock at, and you can't go wrong. Now, one thing that will help you tremendously with not losing money, at least for me, is taking the simple step to knowing what's going on in the finance and investing world. This is where today's video sponsor comes in, the Daily Upside. The Daily Upside is a daily newsletter written by former investment bankers, scholars, and journalists. It's about a 5-minute read that isn't afraid to dive into the hot topics and give real, high-level, unbiased analysis with the occasional splash of wit. Plus, once a week, they publish a deep dive newsletter that unpacks complex business trends, giving you domain expertise in an easy to understand voice. What a lot of people don't realize is that many news articles are written by AI these days. The few that are written by actual human beings are littered with bias and political agenda. This is especially difficult because if you are interested in getting the news about the markets, you want unbiased and non-agendized news. Non-agendized? You get what I mean. Even worse, many of the journalists covering finance stories aren't able to fully understand concepts that are important to the article because they aren't finance journalists. This is why I get my news from the Daily Upside, because it is finance news for finance people, written by former investment bankers, scholars, and human journalists. See, for me, I use the Daily Upside to understand the macroeconomics that I would need to trade options or invest in stocks. I'm going to leave a link down below to the Daily Upside. Sign up and you won't regret it. Selling cash secured puts will be similar to selling covered calls, but there are a few key differences worth going through that are important. The most obvious difference is that we are selling puts rather than calls. But also the collateral that we will use is going to be different. For covered calls, we use shares of the company itself that we own as collateral. If we lose the trade, we would have to give up our shares. Now with cash secured puts, the collateral is in the name cash secured. So we are securing or covering our position using cash. So instead of having 100 shares of the company, we will need enough cash to buy 100 shares of the company if the shares get assigned to us. Now, when we sell a put, we are agreeing to buy shares at the strike price if the strike price is reached. This is why we need cash just in case our strike price is hit. We will be forced to buy shares, which is what the cash is for. Now, just like when we sell calls, our max profit that we can make from selling puts is the credit received. We can't make any more money on this trade than the credit that we received for selling this option. Now, here is where it gets a little bit tricky. The max loss on this trade will depend on what happens sort of after the trade, more so than what happens during the trade. Now let me explain. Let's take Apple again as an example. It's trading at $100 and I decide I have enough cash to sell a cash secured put. I sell a put lower than the stock price is trading at, so let's say at $95 strike price, and I say I don't think Apple will drop below $95 by the expiration date. Well, if it doesn't, great, I will keep the entire premium, the credit received for selling that put. But if Apple falls to, let's say, $90, then what happens? Well, based off of the agreement of the option contract, you will be forced to buy 100 shares of Apple at $95. Now here's where the problem comes in. Apple is now trading at $90, so you will have an unrealized loss of $5 per share. Now this differs from the covered call scenario because instead of missing out on profit, you are already in the red. If you sell, then you are accepting that loss. Or you can, of course, wait for it to recover, which is fine, but that might also mean that the stock continues to go down. Now I tend to have found that selling puts are a bit more successful because the market in general tends to trend upwards. So we can sell puts and collect the premium along the way as the market keeps going up. So it goes up, we sell a put, it goes up, we sell a put. Of course, at one point you might say, well, I probably would make more money if I just bought and held the stock. And yes, you would be correct for the most part. There is always a trade-off to safer investments like selling covered calls or cash secured puts, and that is something that you would need to decide if it is right for you. Okay, one thing that I want to talk about is selling naked options. Now, what is selling naked options? Well, you take off your clothes and you open up the Robinhood app. Whoa. Take it easy. Alright, sorry. Alright, so naked options means that you are not covering your position. So you're selling calls without having shares as collateral, or you're selling puts without having cash as collateral. You should never do this. Don't even think about it. Now, fortunately, Robinhood does not let you sell naked options, and most brokerages don't allow you to do this, but some might. So I just want to give you this as a warning. It is the ultimate max loss potential if you sell options without collateral. So let's say you have a small account and you sell a call on Apple without having shares as collateral, and your strike price is hit. You will now be on the hook to buy Apple at the current market price and sell it at the strike price. So you sold the $150 call, but Apple is now at $170. Well, now you have to buy $17,000 worth of Apple stock so that you can sell it for $150 per share, and that is for one contract. If you sold 10 contracts, then you would have to come up with $170,000. So you can see how this becomes very dangerous very quickly. Same thing on the put side. So if you sell a put on a stock at a $20 strike price and the stock drops all the way down to $10, then you will be forced to buy stock at $20 with the money that you might even not have and then sell it for $10. What's even worse is that even if you come up with the money to buy the stock has lost already half its value. So keep this in mind if you ever are in a situation where for whatever reason you can sell options without having collateral. Just don't. Okay, for today's bonus tip, and this is something that you should start getting a grasp of sooner rather than later for your investing in general, but more so when it comes to option trading. And that is your risk reward for your trade. You should be able to take a look at a trade and determine the risk reward for that particular investment. Let's take a very basic example. If I buy Apple stock and put $5,000 in today, what is the risk reward? Well, we know the worst thing that could happen is Apple goes bankrupt and the stock goes to zero. Now, I think we could all agree that this is unlikely to happen, but it still could happen. You never know. Now, what is the reward? Well, Apple can go up in value. Now, how much can it go up in value? Well, hypothetically, it can go up forever, right? For the next 10, 20 years. Apple can 10x from here in our lifetime. But Alex, Apple has a $3 trillion market cap. Can it still go up from here? Yes, I realize 3 trillion might seem like a lot, and a 10x move from here would mean Apple would be worth $30 trillion. But keep in mind that the same thing was said when the first companies hit $1 billion market cap. So your risk reward is losing $5,000, all your money, highly unlikely, versus 20 years of growth of one of the strongest companies today. Would you make that investment? I think many would, because the risk reward seems to be in your favor. On the other hand, if you look at a penny stock, for example, and put $5,000 in, well, there is more risk than there is reward. So you might not want to take that investment because the risk side is more likely to play out rather than the reward side. Now let's take the same concept and apply it to options. When buying calls and puts, we are risking buying options, which could more than likely just go to zero in exchange for the reward of having higher than average returns. Now for weekly contracts, it might not be worth it for you because the risk might outweigh the reward. For something like leaps that I invest in, where you have more than a year or 2 years out till expiration, you can make similar returns just spread out over time. Now we were looking at, let's say, buying an option contract for $5,000 and having it maybe 5x in the next year if the stock moves in your favor. Would you risk $5,000 now that the risk is lower and the reward still is relatively the same? Maybe. This is why I love selling covered calls on stock that are in my portfolio that are already in the profit. The risk to me is being forced to sell my stock, but if I'm already in the profit, then there really is no risk, at least, of losing money. And if I sell the right options, chances are I won't even have to sell my stock anyway, and I collect the premium along the way. So the reward is free money, and the risk is selling stock at a profit. The risk reward is in my favor, so I would take that trade any day of the week. Now, everyone is different, so your risk reward will be different from mine, and that'll be different from the next investor. You have to determine what risk reward makes the most sense for you and start writing down these for each trade or investment that you take on. Write down the risk and then also write down the potential reward and how likely that is to happen. I think that this will put everything into perspective, and a lot of the times this will stop you from making poor decisions with your investments. Now, if you are curious as to what trades I am making in my portfolio and want to sort of track my trades, I have left the link down in the description below. If you want to join my journey and learn more about trading and options and investing in general, then you might find some value in it. So check the link down below. And as always, thank you so much for the continued support in watching these videos and hitting that like button too. A little tap there. Ding, little bell goes off, ding. And maybe share this video around to someone who needs to stop losing so much money in the stock market. Now, if you have enjoyed this video, you'll definitely enjoy this one here. And also this one here is pretty good too. Thank you so much. Have a great day, everybody. And we will see you on the next video.